The sudden collapse of Terra sent shockwaves through the crypto industry. Holders of UST and Luna lost a total of $42 billion. Major investors like Coinbase Ventures lost millions of dollars as well.
$40 billion didn't just vanish. More than 1 million investors worldwide lost everything when Terra collapsed. Its founder, Kwon, has now pled guilty.
Disgraced South Korean cryptocurrency mogul Kwon on Tuesday pleaded guilty in the United States to 2 fraud charges connected to the $40 billion collapse of Terraform Labs' digital currency ecosystem. The 33-year-old entered the plea at a Manhattan federal court, where under the deal with prosecutors, Kwon will face no more than 12 years in prison if he abides by the agreement. This is despite 9 charges he was facing under the indictment and sentencing guidelines calling for roughly 25 years in prison. Sentencing is scheduled for December 11th.
But here's the shock. Under his plea deal, he will forfeit just $19 million. $19 million out of $40 billion. Where is the rest? And why will victims likely see almost none of it back? To answer that, we first need to understand what Terra was, how it worked, and why it collapsed in the first place. Terra wasn't just another crypto project. It sold itself as a self-contained financial world.
In late 2021 and early 2022, a new crypto system called Terra was taking the world by storm. At the peak, its associated crypto coins had a combined market cap of over $60 billion. Unlike many other altcoins, it wasn't just retail investors and meme traders pumping up the price. Some of the biggest heavyweights in the institutional crypto space, including billionaire Mike Novogratz and the trading firm Jump Crypto, were investing billions of dollars into the project. It was run by a charismatic South Korean technologist called Kwon, who said that his project was already achieving mass adoption in Korea and will rapidly expand across the globe. Terra promised to revolutionize the global financial system by cutting out inefficient middlemen and making it seamless for people to transact with each other across national borders.
At the center was Terra USD, or UST, a stablecoin meant to always equal $1 US. But unlike USDC or Tether, there were no real dollars in reserve. Its value was backed only by Luna, Terra's sister token. Here's how the system worked. 1 UST could always be exchanged for $1 worth of Luna. If UST slipped to 95 cents, traders could buy it cheap, swap it for a full dollar of Luna, then sell that Luna on the open market. In theory, this arbitrage pulled UST back to its peg. If UST went above $1, the system burned Luna to mint more UST, pushing the price back down. To create demand for UST, Terraform launched Anchor Protocol, a savings platform that paid nearly 20% annual interest. That rate wasn't organic. It was heavily subsidized by Terraform and its backers, but the promise of risk-free yield was irresistible. By early 2022, Anchor held more than $18 billion in deposits. Together with Luna's soaring market value, Terra's ecosystem swelled to over $40 billion. Terra was about to face the ultimate test. The system depended entirely on faith that UST would always return to $1 and that Luna would hold enough value to absorb the shocks. In May 2021, that faith was already shaken once. UST briefly crashed to 94 cents. Terraform told investors the algorithm restored the peg. In truth, it was Jump Trading, a Chicago trading firm, that secretly stepped in. Jump spent hundreds of millions buying UST, pushing it back to $1. For that rescue, Terraform rewarded Jump with deeply discounted Luna. As Luna soared, Jump's profits exceeded $1.2 billion. But retail investors never knew. They were told Terra had proven its stability, when in fact it was propped up by one firm's hidden bailout. By early 2022, the tide was already turning. The Federal Reserve had begun raising interest rates at the fastest pace in decades. Risk assets were crashing, and crypto had entered a deep winter. Confidence was evaporating, and many investors wanted their money back. In May 2022, the cracks widened into a catastrophe. Billions were pulled from Anchor. UST slipped below $1 again. But this time, no rescue was big enough. As redemptions flooded in, the system minted more and more Luna. Supply exploded, Luna's price collapsed, and the peg snapped. Within days, Terra USD was worthless. Luna, once over $100, became fractions of a cent. $40 billion in value gone. And yet money never truly disappears. It moves. The real question is, who caught it on the other side? When the spiral hit, the losses were devastating. More than 1 million investors worldwide held Terra USD or Luna. In Korea, retirees poured in savings. In the US and Europe, small investors parked cash in Anchor, convinced by its 20% returns. Across Asia, UST was even used for payments. For these investors, there was no exit. By the time Terra USD lost its peg, redemption meant trading into Luna that was collapsing by the hour. Deposits in Anchor, $18 billion at its peak, drained to almost nothing. And the harsh truth, most of these victims will never recover a cent. Regulators have frozen or seized less than 1% of the losses. For the overwhelming majority, their money has simply vanished. Not everyone lost. Court filings show Terraform executives quietly shifted hundreds of millions offshore before the collapse was complete. South Korean prosecutors allege Kwon himself moved more than $100 million worth of Bitcoin. The US SEC traced millions into Swiss banks. His guilty plea covers just $19 million in forfeitures, a token sum compared to what investigators believe he pocketed.
Also, as part of the plea deal, Kwon admitted to conspiring to commit commodities, securities, and wire fraud. He will also forfeit over $19 million, proceeds authorities say were illegally gained. Kwon will also relinquish his stake in Terraform and its cryptocurrencies. Meanwhile, if Kwon serves half his sentence and meets all conditions of the plea bargain, the U.S. Justice Department will support his request to transfer to South Korea under the International Prisoner Transfer Program.
Co-founder Daniel Shin is accused of cashing out tens of millions by selling Luna before the collapse. He denies wrongdoing but now faces trial in Korea. Other insiders routed funds through shell companies and offshore wallets. Regulators estimate hundreds of millions were extracted. Wealth taken from the system, while retail investors were left with nothing. At its peak, Anchor Protocol held $18 billion in deposits. That was the only pool of real money inside Terra. So where did it go? Much of it was siphoned out gradually, long before the crash. Early Luna investors and venture funds cashed out when Luna's price soared more than 100-fold in 2021. Pantera Capital, for example, turned a $1.7 million seed investment into more than $170 million by selling Luna into that liquidity. Another portion went to Anchor depositors who withdrew early. On May 7th, just days before the collapse, two large wallets pulled out $375 million worth of UST in a single day. Those funds, principal plus months of 20% interest, were safely converted back into real dollars before the system failed. CNBC highlighted the event in its reporting.
I'd say the trigger was on May 7th, when on the platform, a decentralized finance application platform called Curve, which is often referenced by traders to assess the stability of the peg of stablecoins, there was a major trade that was made where someone came in and exchanged $85 million of UST for another stablecoin. And this started to cascade into additional exits in these liquidity pools. And this caused the initial depegging and the beginning of the spiral.
And then there were the losers. The investors who held Luna at peak prices or who left their UST compounding in Anchor until the end, they were left with nothing. When you strip away the mechanics, Terra was simply a cycle of deposits and withdrawals. The $18 billion that came in didn't disappear. It moved, out to those who sold Luna at the top and to those who exited Anchor while it was still good. Beyond insiders and early withdrawers, powerful institutions also walked away with profits. Hedge funds that shorted Terra USD or bet against Luna made billions as the spiral unfolded. And then there was Galaxy Digital, led by billionaire Michael Novogratz. Galaxy invested early in Luna, selling the vision that Terra would become a global stablecoin system. Luna's utility, they argued, was to back Terra USD. As demand for Terra's stablecoin grew, Luna would be minted and burned, driving its value higher. For investors, the pitch was simple. The more UST adoption, the more Luna would soar. Novogratz went all in, even tattooing Luna's logo on his arm. However, his enthusiasm for the Terra project eventually gave way to silence when Terra Luna collapsed.
Bloomberg West, Bloomberg Technology. He made me want to buy crypto, Sue.
Well, he is viewed as a king in the crypto DeFi ecosystem, as it were. And yes, he is relatively quiet right now. There hasn't been a tweet from him since May 8th. He himself, a billionaire and a Wall Street veteran, has described himself as the Forrest Gump of Bitcoin. He recently, in fact, got a tattoo of a wolf howling at the moon with the word Luna. That's a nod to what was the hot new algorithmic stablecoin in the Luna Terra ecosystem that just had this past week a spectacular collapse.
But Galaxy wasn't just a believer, it was a winner. By the time Terra collapsed, the firm had already realized more than $1 billion in profit. In 2025, it paid $200 million to settle with New York's Attorney General over its promotion of Luna, without admitting wrongdoing. For small investors, Terra was ruin. For institutions with capital and access, it was opportunity. As Terra imploded, billions in trades rushed through the world's largest exchanges: Binance, KuCoin, Huobi. Retail investors frantically dumped Terra USD, sometimes for 60 or 70 cents on the dollar. On the other side of those trades were whales and institutional desks. Some over-the-counter desks quietly moved massive blocks of UST for hedge funds, allowing them to exit positions before prices collapsed further. Arbitrageurs used speed to buy distressed UST, redeem it for Luna, and flip the Luna before its next leg down. For small investors, it was chaos. For those with access and capital, it was profit. Wealth flowing from millions of wallets into the hands of a few. Governments have spent years chasing Terra's vanished billions. U.S. prosecutors proved Kwon shifted millions into Swiss banks. Korean authorities froze small amounts at home. But together, these scraps add up to less than 1% of the 40 billion lost. The rest is gone. Some evaporated in Luna's hyperinflation. Some was pocketed by insiders, institutions, or trading firms. Tens of billions remain untraceable, scattered across shell companies, cold wallets, and offshore accounts. The hard truth: victims are unlikely to recover more than pennies on the dollar. Terra's collapse wasn't just the destruction of value. It was one of the largest wealth transfers in crypto history, from everyday believers to those who knew how to play the system. For more than 1 million victims, the question remains, will any of it come back? The answer is bleak. With less than 1% of funds recovered through asset freezes and forfeitures, most will never see restitution. Civil lawsuits grind on, but Terraform itself is bankrupt, and its executives face prison, not payouts. Unlike traditional financial collapses, there is no safety net here. No FDIC insurance, no government bailout. For victims, the 40 billion is gone, transferred into other hands or lost to the spiral forever. Terra proves one thing: in every collapse, money doesn't disappear, it moves. $40 billion shifted from everyday investors into the pockets of insiders, institutions, and the unknown. This is Wealth Decoded, exposing where the money really goes, behind every scandal. Subscribe if you want to see more investigations into the hidden flows of global finance.